Last week was a killer if you got caught on the wrong side. Guys, my name is Hamilton. I'm here at the Trading Initiative. Let's wrap up this week, April 19th, 2024. Let's talk through it. We'll start off here with this intermarket analysis. Before we dive into this, Q's down 5.39. I just want to tell you that NVIDIA ended a lot of traders' careers on Friday. If you were one of those traders that caught the 0 DTE short on Friday and you made a bunch of money, congratulations. I've seen some outrageous pictures like $500 to 50,000. You deserve it. You've waited 6 months to take the short. Hopefully you didn't lose too much money on the way up, but if you waited and waited and waited and finally nailed it on Friday, you deserve your props. At the end of the day, it's all about making money in the market. Do it however you can, but I will tell you that a lot of traders / investors bought into the AI bubble hype BS that this thing will never crash, and NVIDIA ended along with SMCI, along with some of the other semiconductor names, just brutal moves, ended these guys and girls trading careers early. A lot of them are going to exit the market forever and never come back because they think it's a scam now, and that's too bad. It's all about managing risk on the way up, not adding capital to areas of the market that are not performing at the same rate as they were when they were performing well. And we've talked about that a lot in this channel. So shout out to the traders that did not lose their ass on Friday. I did not participate to the downside whatsoever, but I also did not get killed on the Friday pullback with semis because all of my positions were risk-free. I did lose a bunch of unrealized profit, but that's okay with me because nothing from my account was risked, and so I'm happy with the way that I've been able to play this. Once again, the Q's down 5.39% on the week. S&P 500 down 3.05%. Crude down, but energy up on the week last week. Russell 2K down 2.79%. This is risk-off territory for us for smalls and mid-caps. We'll talk through that in a second. Mid-caps down, emerging markets down, bonds down week over week over week. We were talking about watch out if bonds break below 92, particularly in the equity market. The bond market is the most liquid and the most important market in the world. That's where all of the biggest players in the world are trading. And we know right now that the bond market and the equity market are positively correlated. So if the bond market breaks down, you have to assume there's going to be a very big challenge for the equity market to not also break down. And that's unfortunately what we saw. The bond market broke down two or 3 weeks ago below 92. And since that happened, the market really had no real oomph to continue to go up and to the right. And then on Thursday and Friday, we saw the nasty sell-offs. And so I don't think it's a coincidence whatsoever that bonds broke down first and equity markets followed. It's part of what's been going on over the last 2 to 3 years. So if you don't know that, pull up your bond chart, your TLT, your 20-plus year TLT bonds or your treasury bonds, and track it. Just use it as a technical tool, right? You don't need to trade bonds, but understand there's a positive correlation to that. So if bonds break down, it's reasonable to assume that the equities market at the very minimum is going to have a very hard time continuing to go up over time, right? So let's go ahead and look at U.S. sector performance year to date because we did see some nasty pullbacks last week. Energy still up the most here, 14.19%. Have to ask you, if you don't have energy exposure right now, should you be looking to buy the pullback in sector leading stocks? I don't have the answer for you. I'll tell you that we are long energy. We did add into some pullbacks in energy. We're long XOM, CVE, NXE, VLO, MPC, a bunch of different energy-related names. We like this sector going through the rest of the year, and we do think that this slight pullback in energy offers an opportunity for a higher risk-to-reward trade. I'm not saying that the trade is going to work. I'm saying that there's a higher risk-to-reward here because you're buying at logical levels post-pullback, so you're getting a better deal instead of chasing into new highs. Calms down week over week once again, but still up 9.67%. Financials catching a bit over the last 2 weeks, up 7.8%, and industrials up 6.01%. The rest of the stuff is underneath SPY. Let's talk about the craziest thing. This is a second-year bull market. I'm not going to argue about that with anybody. This is the second year of a bull market, and tech has contributed nothing to it. It's up 0.19% on the year. Most of that is Apple weakness, but still, it's crazy to think that the S&P 500 was at all-time highs with tech really not performing well whatsoever. And consumer discretionary down 4.85% this year. Most of that is Tesla, but once again, these are huge stocks that are not performing well whatsoever, and yet the indexes are continuing to perform pretty okay. So it's crazy to think about the indexes breaking out to all-time highs and continuing to chug along without some of the largest components within that index really participating whatsoever. And as a matter of fact, Tesla is the worst performing S&P 500 component this year. If we go back 1 month, though, you can see that we are seeing a lot of that defensive rotation, right? Energy, utilities, financials, staples. This is almost exactly what we saw last year from late July through late October. This is almost exactly what we saw last year, rotating out of growth and into value. The only difference in my mind is the fact that this has been a rather aggressive move over the last few weeks, 2 weeks, particularly out of semiconductors, which we're going to look at right now, which we didn't get last July through October. We didn't get the super aggressive capitulation zones, but that also leads to some potential opportunity, which we're going to talk through in a second when we look at TradingView here. Semiconductors still up the most, but down from their peak at 35% year to date to only 13.92. And once again, last year was an account killer, was a trading career ender for a lot of traders. So rest in peace, RIP to those traders. For those of you that caught something, congrats. Still, though, the year-to-date leader, that's how frothy the area was, right? So now we can look at energy, gold miners, stuff like that. You can see once again that value and defensive areas are propping up versus some of the growth and riskier areas of the market, like PBW down there at 34.92% to the downside, TAN, but even software down 3.2%. It's really wild to think this is a second-year bull market, and some of these risk-on growth areas of the market are not performing well. Gold miners up over the last month, 14.56%. We do have a position in EGO on that is working well. Metals and mining, XME, we have a position in Steel Dynamics, completely free. Jets popping up post-earnings, nice to see. We do not have a position in Jets. That chart is going to be a tough chart to trade. Jets and pretty much all of those airlines, a lot of them have significant overhead supply to fight through. But it is encouraging to see that earnings, they're responding well to earnings. They're like the only group right now that's responding well to earnings. That's nice to see. Oil, gas, exploration and production, XOP up 3.7. You can kind of see where we're going with this, right? Defensives and value outperforming growth and risk on. Talked about this over the last 3 or 4 weeks. The last video we put out is watch out, essentially. And that's what we've been doing. We've been watching out. We did not make a bunch of money as a community to the short side on this, but we certainly did not get caught with our pants down and with a bunch of new positions with no risk taken out whatsoever. This has been a pretty easy pullback for us. I won't say that we made a bunch of money on the short side, but it's been pretty easy managing our expectations because we've seen it coming. We've seen it coming, right? Year to date, realistically, the trade was, over the last few weeks, was Mag 7, right? You can see that large cap growth stocks were starting to get crowded into April. We were asking ourselves inside of TTI, was this because they were a flight to safety? Was that what it was? Or were they going to break out and the market was going to rally? And we didn't know what the answer was. We did understand the overall market environment. The market wasn't doing anything. Semiconductors were looking toppy. And we didn't want to add new capital to a bunch of different positions. So what we did is we went out and bought Google. We went out and bought Amazon. And although the Google trade did start out working and Amazon did work for a couple of days as well, we're both down on both of those plays right now. But we were constantly questioning ourselves, is this a safety play or is this like the market is trying to front run the next breakout? Either way, we're comfortable owning both of these, which we're going to look at in a second when we get to TradingView. But now over the last 2 sessions, Thursday and Friday, the Mag 7 stocks got slammed, particularly some of the biggest stocks in the world, right? Apple, you see pullbacks in Amazon, Tesla continuing to get crushed, and now all of a sudden you see against the broader market index, the S&P 500, the Mag 7 stocks, the large cap growth stocks are underperforming. And the value areas are popping up. Large cap value starting to see a bid here. If we go back 1 month, you can really see it, right? Look at all the value areas starting to pop up. So once again, I'm not sitting here telling you to sell all of your tech stocks. That's not what I'm doing. As a matter of fact, I don't want you to do that. Why would you want to sell your beautiful tech stocks, especially if you have fantastic entries? If you think about the corrective phase that we went through last year from July through October, it was not just sell everything and you're going to make a bunch of money. Go short the market, you're going to make a bunch of money. It was very choppy. It took 3 months for the market to lose 10%. I would prefer to be in the situation that we're in right now, where we've lost 5% in a single week, because at least to me, the light at the end of the tunnel is going to come a lot quicker than what it came like last year, where last year was just 3 months of nothing, and it was so boring. People were just getting chopped to shit, like just throwing cash at any position with no real rhyme or reason because they were bored. I think that now that we're getting these intense market pullbacks, as long as we can keep our head on straight, look at levels where we want to buy, wait for divergences in momentum and that classical kind of bottoming out type of internals that we normally look at, MACD, RSI, stuff like that, we can buy the bottom or get pretty goddamn close. We're not there yet, I don't think. We're going to look through that in a second, but I don't think it's time to go and sell all your tech stuff. I do think that it's an opportunity to allocate some of your capital to value areas of the market that are starting to outperform. If we're in a second-year bull market, I don't think that energy and financials are going to shit the bed, to say the least. They might leg through the end of the year through tech and stuff, but I think these are going to be totally fine positions, and we're starting to see it right now in the market, that the market is buying those. They are rotating, and you can see it right here. They are rotating into those value areas. So something to consider. One thing I will point out here before we get into trading view, if we look at Twitter, this is once again Almanac trader Jeffrey A. Hirsch. Highly suggest looking at his Twitter and or buying his product. I absolutely love his product. The S&P 500 election year seasonal pattern 1949 through 2023. When he filters through the big election year Q1s, and the way that he said that he filtered this out were Q1s that bucked the trend, that just did way better. And as you can see, the red line is a lot higher than the black line. So black line is all election years, and the green line is the best Q1 of the election years going back to 1949. We had arguably the best ever Q1 of an election year. And this sweet little proprietary yellow box says, listen, there's generally going to be a dip before summer starts, and then there's 7 months, classically 7 months of pretty much straight up. And so this should not be unexpected. Now, I will tell you that we expected this to happen a month or two ago. It didn't happen. We remained long, but we're not caught completely off guard into this sell-off. And I don't think most of you guys probably are either. For those of you that have been sitting here waiting to be short, this is your opportunity to be short. I hope you're actually making a lot of money. Seriously, it's a very tough trade to take counter trend trades. So if you've been sitting here waiting to be short, this is your time to be making it, banking on it, everything else before the bottom is in, because the bottom will be in a lot faster than what most people think. Most people expect that we're going to break into new lows. We're probably not going to, guys. I'm telling you, just at least statistically, it's always going to feel like the worst thing ever. It's probably not going to happen. Let's actually look at it really quick. SPY here. And the reason why I have the 50-day moving average on, which I don't normally do, is I want to point something out. Right now, you have 50-day moving averages broken, but you still have the 200-day moving average sloping up and to the right and prices up and over it. Tomorrow morning in the newsletter, as it goes out every single Monday, we're going to be looking at weekly trend. We keep things objective inside of TTI. There's no emotion, there's no bias, there's no opinion, right? We look at trend and price. Where are we in terms of the trends? And in this case, moving averages. If we're below the 50 moving average and above the 200-day moving average, and the 200-day moving average is sloped up, the primary trend is almost always still going to be intact. The 50-day being broken to the downside introduces a short and potentially intermediate term downtrend and or choppiness. And that's exactly what we're trading for right now. The way that we trade through this is either lowering our position sizing or taking less trades. We can also join in on the option selling side, selling premium, stuff like that. But realistically, if you're a swing trader and you work full time or you own a business, you don't have time to be sitting here in front of your computer all day, every day, monitoring short-term shorts. The best thing you can do in this type of environment is simply sit out, cash as a position. If you don't have time to do this stuff, like some of the guys that, trade full time do, just don't participate. It's like a poker player. You don't need to play every single hand. So the SPY right now breaking below its 50-day moving average, still north of its 200-day moving average. We expect this to potentially continue to pull back to previous all-time highs. It wouldn't surprise me to see it undercut it slightly, but we do think that it can come down here, and if it does, we want to buy the bounce. If this were any other chart other than an index, people would say this is a simple breakout, retest, bounce. Why is an index any different? That's how we're going to treat it. Obviously, we're going to wait to see some momentum divergences down here in the RSI, stuff like that. But still, I'm not afraid to own this. I have no idea when it's going to be down here. But given the fact that we're already down as fast as we are, I love this more than I liked this. This was not an easy tradable event for 3 months. Everybody throwing cash in there and just getting bored and just getting chopped up. I would way rather have capitulation, because capitulation brings opportunity a lot faster, right? The cues here, you can see that we absolutely got murdered last week, and you can see that I'm already here. I'm focused on when I want to buy. I'm not focused on how am I going to short this into new lows. I'm not in that mode. And by the way, we break the 200-day moving average and we're down somewhere near 380 or something like that. I have absolutely no problem admitting that I'm wrong, and we're going to catch, trades to the downside. I don't have to be the first one to be in a market to short it, but I don't think we're there. We're a second-year bull market. Every single year has a correction. Every single year has a correction of 10%, and they generally have a few 2 to 5% pullbacks as well. I think this is just number one. I think this is part of it. And I'm going to be interested in owning something around the 400 or slightly below it near the 200-day moving average at 395, something like that. That's where I'm focused. I'm focused on owning strength down there. Once again, we want to not just buy it indiscriminately. We're going to want to watch for some sort of bullish divergence in momentum and stuff like that. I think IWM is going to be the most challenging buy, to be honest with you. We don't want to be long, small, mid caps, any new positions until very minimum we're up and over the 198.5 or 200 area. I mean, we fought through a range for 2 years, And inside of TTI, we stayed out of this. And that was the right call. This was a very challenging area to trade for 2 years straight. Even when the other market, when the other areas of the market started to break out, particularly large caps, we were long those. We still did not go long smalls and mids with any sort of size or any sort of veracity because we were sitting here waiting for the Russell 2K to break above the $200 area. And that just simplified our trading last year. Well, we finally got it. We got long. A bunch of mid caps made us a lot of money. But now that we're back within the range, we're just going to go back to what we did last year that worked. We don't want to be long this area of the market as long as we're underneath the $198 to $200 area. This is still the same range we were stuck in for the last 2 years. I don't want anything to do with it. I think it's just that easy. Just take it off of your watch list until the Russell 2K is back up and over that area. Once we're back up and over this proprietary line, I think that represents a path of least resistance to the upside. But as long as we're underneath it, just don't trade it. That's how I'm going to trade it. Just staying away from it. RSP, the equal weighted equal weighted S&P 500 breaking below its all-time high down here. There is a slight divergence. The S&P 500 ended down, but RSP ended green on the day. That is a little strange. We're starting to see a little bit of a curl back up on the RSI. This is an equal weighted S&P 500 showing you that all of the stocks in the S&P 500 equaled the same. We actually finished green on the day. That was different. Now the Qs are on the other story here. Equal weighted QQEW, the NASDAQ QQQ, got killed along with the rest of the stocks in the growth space, right? Qs just got absolutely slaughtered. So once again, we're talking about the value versus growth conversation, energy, financials, sometimes industrial, stuff like that. They're catching a bid. They caught a bid at the end of last week, whereas tech, consumer discretionary, and comms absolutely did not. Think about where you want to be allocating capital right now. I would probably wait to buy the dip in some of these growth areas of the market until we find some sort of floor. The dollar above 107 is what concerns me. Obviously, we know that every time the dollar heads up, the market heads down, and every time the dollar heads down, the market heads up. I would be worried above 107. I'm not necessarily worried about the Dixie until we break 107 and we're into new highs, and I'm not necessarily worried for I wouldn't be worried. If the dollar broke below 100, I would expect the market would be friggin' flying. But we're not there yet either. We're still stuck in this range that we've been in for the last 2 years, and we know that, once again, there's an inverse correlation between the dollar and the market. Every time dollar goes up, market goes down. Every time the market is going up, the dollar is going down. Well, the dollar's been going up for the last couple of months, which has led to less and less enthusiasm for buyers as the S&P 500 is broken into new all-time highs, and obviously we're up here near that 107 area. What happens if we flip it? I think if we flip it, the market is going to continue to experience a lot of pain, and if not, I think there's going to be a light at the end of the tunnel. Once the dollar breaks back down and starts heading down here, buyers are going to show up in the indexes and want to own stocks again. That's how we're going to play it. Talked about bonds. Below 92 was a watch out. There's that 92 level. There's nothing we want to do with bonds here. There's no floor here. There's no nothing. If we come back up, that's great. I think the 92 level, once again, is going to be key. Breaking above the 200-day moving average, I think, is going to be awesome, but I have no idea when we're going to do that as of right now. We have no active position in TLT. We're just using this as kind of a puzzle piece. Below 92, we said be careful adding new positions in the market, and we did. We're still currently trading below the 92 area, and this is just not a great-looking chart for bonds. Really quick, we're going to go through a couple sector ETFs. XLK absolutely murdered. Once again, do we continue to want to buy tech? Not yet, but I do think the light's at the end of the tunnel. I'd be looking for a 200-day moving average bounce, but probably an undercut, probably closer to 177, 178 in XLK. Can't talk about tech without semiconductors. Semiconductors got absolutely destroyed. We said watch out at the $200 area. There's probably going to be some support there. We closed at 199.21. There's no scientific method behind that. It's the law of big, nice, round numbers. Go through the CMT material, they say it's real, but we don't know why. Well, that's fine. I think it's because human beings are drawn towards those. So there's support there at 200, the $200 area in SMH, but is that going to hold? Probably not. We're not buying the dip here yet. I think that semiconductors are probably going to continue to have a hard time moving up, particularly if we break this area, and I would be looking to buy somewhere near the 200-day moving average winner if we get down there. And we know that AMD, MU, TSM, and then NVIDIA all got killed on Friday. And this, I think, is the most worrisome chart. This is the stock that kind of defines the semiconductor bubble, if you will, right now. And on Friday, it got absolutely hosed. The one good thing is that most of these momentum indicators are down here at oversold areas. But listen, the market doesn't have to bounce just because something is oversold. I'll tell you that right now. It's the same reason why markets don't have to crash when something's overbought. This thing coasted for like 4 months straight, 5 months straight, while hitting new all-time highs, even though it was overbought. So don't buy into it's oversold, it has to bounce. No. Let's use our brains and wait a little bit longer for an actual bottom to form. Let's talk about things that are moving up and to the right, particularly energy, finding support at previous all-time highs and bouncing. That's something that we are long and want to continue to be long. And then financials, once again, breaking below the 200-day, breaking below all-time high, but catching a bid over the last few sessions. We think that if XLF breaks back up and over 41, that's probably just going to be an awesome opportunity for new positions to be open, new opportunities in the financial space. We're still long financials, but we're looking to add exposure if we get back up and over 41, which could be as early as tomorrow. I have no idea what's going to happen here. Two positions that we opened up last week. So once again, the market is not conducive for our type of trade. So we're just kind of sitting on the sidelines here waiting for the dust to settle. There's no reason for us to continue to commit capital into something that is not fruitful for our edge. And our edge is buying breakouts either in bull markets or bear markets with momentum. And right now the market correcting the way that it is, we don't want to be opening up a bunch of positions in growth areas of the market and some of the value areas of the market we already have positions in. So we're just kind of sitting on our open positions right now. But one position that we did open up was Wells Fargo prior to earnings. We were able to sell it on Friday for over 100%. This was just a quick flip for us to keep us in the game, and then we did open up a short zoom. You see down here, our trigger was $60, closed at 59.45. This is a slight winner as of right now. We have no idea what's going to happen, but if the market continues to capitulate, we would assume that Zoom is probably going to be one of those stocks that's also going to get crushed because, well, we've been sitting at a support level for the last year or more. We've been sitting here waiting to short Zoom for a year almost. And shit, if the market's going to continue to crash, we think Zoom's probably going to capitulate down. I have no idea where it's going to go. I'd probably say $50, but we have $55 puts. We'll see. Once again, these are just quick, aggressive shorts to get skin in the game and for us not to get complacent with the market. Our main goal is still buying the dip, which leads me to the last thing I want to talk about. You don't want to chase shorts in this type of market. If you were short on Friday and made a bunch of money, congratulations. Seriously, you deserve your praise. Particularly those of you that didn't waste money for the last 6 months crying that the market can't possibly continue to go up. Guys, it's going to continue to go up whether you like it or not. It's going to go up. It's probably going to be higher next at this day. By the end of the year, it's probably going to be higher. A year from now, so next April, it's probably going to be higher. I'm sorry to tell you bears that think the world's going to end. It's probably going to be higher. That's how stats work. If you want to bet against that, that's totally fine. But if, once again, made money on Friday, congrats. Don't chase shorts, though. If things are already capitulating, your edge as a shorter, as a short seller, as a bear, is significantly hindered. You want to catch those things before they start to capitulate. And that means big moves to the downside where it doesn't look like buyers can hold on any longer. Maybe they continue to go down. But where is your risk level if they don't? What happens if it bounces? Then what happens if it continues down? It's a really difficult trade to trade if you're not in from the very beginning. Timing matters from the short side way more than the long side, which is why most people should probably avoid it, particularly those of you that are working full-time or own companies. We're going to wait for momentum divergences, right? What does that mean? We're going to wait for some momentum indicators to tell us that sellers are exhausted into new lows, stuff like that. So some support levels to be formed before we start buying stuff with a lot of cash. That's generally what we like to do. It's what we did last year from October, middle to late October last year. We opened up a bunch of different positions, and that ended up being the best 6-month run we've ever had as a community. We're going to run the exact same playbook this year. I don't see any reason why it's going to be any different. It's just timing, right? This time feels a lot faster, a lot more aggressive, a lot more in our face, which actually I like. I like it a lot because a lot of people are afraid that this is going to bring in a new bear market, that SPY is going to come down and retest October lows. And for those of you that are on drugs, even these October lows, I don't think that is going to happen. And I am very willing to put my capital on the line to take the trade against that, right? But we're waiting for classic signs of a bottom. Last thing is we're going to wait to buy the right side of the V, right? So if SPY comes down and starts to bounce, we're going to want to own it somewhere right here. It doesn't necessarily have to be right there at the bottom. We like to own the right side of the V with the uptrend still intact. That is our bread and butter setup, right? That's what we did last year. That's what we're going to do again. That's what we're going to do in the future. Guys, my name is Hamilton. Here's the Trading Initiative. If you like this type of content, please like and subscribe. Shout out to those of you, once again, that made money on Friday. And if you lost a bunch of money, just reevaluate your process. It'll be all right. Trust me. I'll catch you next video.